Hello and good afternoon to those of you who've joined. We're still seeing the participant numbers tick up as people are joining, so we'll just give it another 60 seconds or so before we kick off. So good afternoon, everyone. To all of you in Hong Kong, good morning to those in Europe or other parts of the world. My name is Mustafa Hadi. I'm joined today by Stephen Du and Lydia Tang, and we'll be presenting to you on damages and valuation. The title of our presentation is Introduction to Damages and Valuation. Lydia, if you just go on to the next slide, I'll just quickly introduce the three speakers and we'll get started. So we have, very pleased to have with us Stephen Du, who's a barrister based in London at 7 King's Bench Walk. He's very active in the Asian market around arbitration in particular, and he's kindly offered to start with an introductory session around the legal principles that underpin damages calculations. And then myself, Mustafa Hadi, I'm Managing Director at BRG in Hong Kong and Singapore. I focus on valuation and assessment of damages as an expert witness. And the third speaker, last but not least, Lydia Tang, who's Associate Director at BRG in Hong Kong, works closely on many of my cases. Lydia's Certified Financial Analyst and also focuses on valuation and damages issues. So I think, Lydia, if we could just go to the sort of contents. We have 5 sections to the session this afternoon. So Stephen will kick off with legal principles underpinning quantum and valuation issues in arbitration. Then Lydia will talk through some of the principles from a financial perspective that underlie loss calculations. I will talk about counterfactual scenarios and introduce some valuation methodologies. Lastly, we have an additional session, which I think is quite topical at the moment, where Lydia will discuss valuation considerations relating to climate change-related risks and opportunities. So with that, Stephen, I'll hand over to you to go through the first session.
Thank you, Mustafa, and also thank you, Lydia, for your very kind invitation to me to speak at this workshop. So I am a practicing barrister in England, and I specialise in commercial law and in particular in international commercial arbitration. So my clients come from a variety of industries, the shipping world, the insurance world, energy, banking, but I also act for tech startups as well, so including cryptocurrency businesses. In very, very crude terms, we fight about money, and therefore the question of valuation and quantum is always at the forefront of our minds. Whenever we fight, we have to value things. We have to value all sorts of different things. I'll give you some examples. We have to value commodities, the value of commodities, which fluctuate from time to time. We have to value ships, aircraft. We might have to value the expected return on a joint venture agreement. We might have to value the loss which has been caused by late payment. I currently have a claim which is worth over $100 million simply because there were such severe delays in payment. Where what we're valuing there is simply the value of money over time. We also have to value, for example, cryptocurrency businesses. What is the expected return of such a business over a period of time? The aim of this first section is to briefly set out the common law principles regarding the assessment of loss. By common law principles, what I mean are the principles of law which were originally developed in the English courts, but have now spread to other jurisdictions and are now also applied in jurisdictions such as Hong Kong and Singapore. So I'm going to start with a quick overview. And this slide hopefully gives you an overarching picture of what I'm about to talk about. For the most part, my talk will be focused on compensatory damages, which can in turn be divided into expectation loss and reliance loss. But I'm also going to briefly touch upon other forms of remedies, for example, an account of profits. The reason why these are called compensatory damages is that the amount which is awarded is calculated based on the claimant's loss. The general compensatory principle under English law has been established for over 170 years. The principle is set out in a very old case called Robinson and Harman, which is from 1848, which stated that the rule of the common law is that where a party sustains a loss by reason of a breach of contract, he is, so far as money can do it, to be placed in the same situation with respect to damages as if the contract had been performed. So in order to do so, there are two questions which will be at the forefront of our minds at all times. Firstly, we have to assess the actual position of the party who has sustained a loss. And secondly, we have to assess the hypothetical position of the party who has sustained the loss if there had been no breach of contract. Now, you might recall from the previous slide that there is a question as to whether the expectation loss or reliance loss is to be awarded. Under English law, the answer is that normally it is the expectation loss which will be awarded because that puts the party in the position it would have been in had the contract been performed, had there been no breach of duty. And the result is that this rule should encourage the performance of contracts by putting parties in the position they would have been in had the contract been performed. The alternative, which is the reliance loss, isn't something that's completely neglected in English law, but it has less of an importance. As a general rule, the alternative, reliance loss, is only awarded where there are difficulties in assessing the expectation loss, and we use reliance loss simply as a proxy for what the expectation loss is. These principles are pretty well established. As you can see, the case of Robinson and Harman is from all the way back from 1848, but there are similar statements in other places. For example, there is a similar statement which can be found in the factory at Corfu case, which is a case which was heard before the Permanent Court of Justice in 1927, which stated that reparation must, as far as possible, wipe out all the consequences of the illegal act and re-establish the situation which would, in all probability, have existed if that act had not been committed. I'm going to move on now to briefly touch upon other financial remedies. And two examples which I want to touch upon are an account for profits and exemplary damages. I'm going to do so very briefly because on the whole, these are very rare. So for the first type of claim is a claim for an account of profits. This is where the amount awarded in favour of the claimant is not measured based on the claimant's loss, but on the respondent's gain. And these claims are very rare for two reasons, one factual and one legal. The factual reason is quite simple. Most legal disputes happen when something has gone wrong with a business venture. And when that happens, there generally isn't very much profit to fight over. a claimant will generally do much better by claiming compensation for his loss rather than for his opponent's gain. The legal reason is that the law generally regards it as unnecessary to order an account of profits. So if a claimant has been put in the same position as he would have been in but for the breach, one might ask rhetorically, who cares if the respondent is left with some profit which has not been accounted for? Generally, the only scenarios where an account of profits can be ordered are situations where the respondent has acted disloyally in some way. For example, if there's been a misuse of confidential information, or if an agent has taken a bribe and acted contrary to its principal's interests. In those situations, there is a justification. It would be in the interest of justice to deprive the respondent of its ill-gained profits. The second type of claim is exemplary damages. This is where the respondent has acted so badly that it actually needs to be punished with a particularly painful award of damages. I'm going to say even less here, except that these awards, as I understand, are made in the US courts from time to time, but pretty much never in English law. I've seen some pretty badly behaved litigants in practice, but I have to say I have never seen exemplary damages being awarded either in English litigation or in international commercial arbitration. But we've put the example there because never say never. So I'm going to move on now to talk about the date of assessment. One question which is often argued about when we come to the assessment of damages is whether we should use the date of breach or the date of award as the appropriate date for assessing damages. And you can see a summary of the differences between the two approaches on the screen in front of you. But let me give you an example to apply these principles. It's based on current events, based on an actual case I'm working on. Suppose that you have sold some wheat on the 1st of February 2022, but the buyer fails to take delivery. You then wait until the outbreak of the Ukraine war before reselling the wheat. By then, the Ukraine conflict means that wheat prices have skyrocketed, and you, as the seller, then bring a claim for breach of contract. Do you assess damages based on the pre-war prices? That's your ex-ante approach, assessment at the date of breach. Or do you assess damages based on post-war prices, the ex-post approach, or assessment at the date of award? This will make a huge difference. Now, at the risk of oversimplification, under English law, the answer pretty much lies in whether the victim of the breach can crystallize the loss on the date of breach. So in my wheat case, the date of assessment should probably be the date of breach. And the reason for that is there is a readily available market for wheat, and the seller can immediately crystallize the loss on the date of breach. If the cargo is not sold on the 1st of February, the seller could and should go out and find a substitute buyer on the 1st of February. Damages should therefore be assessed on the basis of a 1st of February price, and you ignore the fact that the Ukraine war has caused wheat prices to skyrocket. But let me give you then a different example. Suppose you have entered into a joint venture agreement to buy a 50% interest in a very specialized offshore drilling platform. There isn't a readily available market for such things. There is a market in the sense that if I have a drilling vessel, there is probably, with enough time and effort, going to be able, there will be someone out there who is willing to buy the platform. But there's no guarantee that I will be able to find a buyer, and there is no guarantee that I will be able to do so immediately. So in those circumstances, the loss cannot be immediately crystallized. The loss, therefore, if, for example, I've been deprived of participating in this joint venture, is probably a claim for loss of profits over time. And therefore, the more appropriate approach is to use the date of award to calculate damages. Finally, I want to quickly address the question about claims for loss of chance. And again, let me do this by reference to an example. Suppose that a lawyer during negotiations fails negligently to advise the client to ask for a particular clause. So to use an example, a limitation of liability clause or a contractual option. The problem is that even if there had been no breach of duty and the lawyer in question advised to ask for that clause, there is no guarantee, firstly, that the client would have followed that advice, and secondly, that the counterparty would have agreed to the clause in question. And there lies the uncertainty. How do we deal with that? And there are two plausible answers here. The first approach is simply to apply the balance of probabilities principle. If there was a less than 50% chance that the client would have followed the advice or that the counterparty would have agreed to the clause, then we conclude that the client would not have followed the advice or that the counterparty would not have agreed the clause, and therefore the loss in question is nil. The second answer is to award damages for loss of chance. So if there was a 40% chance that the client would have followed the advice and a 40% chance that the counterparty would have agreed the clause, then we award damages for loss of chance, which is 40% multiplied by 40%, which is 16% of the total loss. So there would be some recovery in such circumstances. The approach taken by English law and many other common law jurisdictions is broadly as follows. In the example I gave, the claimant, so that will be the client in question, must prove that on the balance of probabilities, he or she, the claimant, would have followed the advice. What is required there is proof on the balance of probabilities. But where it comes to how the third party would have behaved, the claimant has to prove that there was a chance that the counterparty, the third party, would have agreed to the clause. And therefore, the claimant's loss can be a claim for loss of chance, and the damages awarded will be adjusted depending on how high or low that chance was. Now, when we come to the calculation of a loss of chance, there always involves a degree of estimation. And you can see on this slide some of the factors which will be taken into account. Those include whether there was a commercial opportunity of some value, to what extent that opportunity has been lost, and the prospects of success if the opportunity had been pursued. So that gives you hopefully a flavour of some of the principles which are applicable as a matter of English law and other common law jurisdictions when it comes to the question of assessment of loss. I'm going to leave it there and now hand over to Lydia for the next section. But just before I do so, I'm going to pause briefly in case there are any questions.
If anyone does have questions, I think they can be submitted via the chat function or the Q&A function.
Well, I haven't seen any questions coming on the chat function. Of course, we have the opportunity of asking questions at the end of the seminar, so I think I'll just hand over to Lydia for now then.
Thank you, Stephen, for the introduction of the legal principles on valuation and quantum. And now I would like to go on to talk about the key principles on loss calculation, and we will focus on compensatory damages today. First, I would like to introduce the framework under expectation loss. As explained by Stephen, when you quantify expectation losses, you are trying to put the claimant back into the position it would have been in had the unlawful acts or omissions not taken place. It is to calculate the incremental gains a claimant may reasonably have expected to make on his investment. You may often hear quantum experts saying that the loss suffered by the claimant is calculated by comparing the actual versus counterfactual position. The actual position is the actual cash flows of the claimant with the act of or omission from the respondents. And the counterfactual position is the expected cash flows that the claimants would have earned without the unlawful act or omission. It is also called a but-for position, as it represents the position but for the unlawful acts or omissions. The incremental cash flows that a claimant may reasonably have expected to make, which is the gap in between actual and counterfactual position, is the loss suffered by the claimant. By claiming such loss, the claimant would be put back into the position it would have been without the unlawful acts or omissions. As you can imagine, the quantum expert has to make projections about the counterfactual position and potentially the actual position. However, the claimant usually has a duty to mitigate or to take reasonable steps to mitigate their loss. Damages can be reduced if the claimant fails to take reasonable steps to mitigate its loss. Say, for example, a supplier failed to supply certain materials for product A according to a supply contract, and the claimant now claims for losses suffered from the breach of contract. The claimant cannot simply assume that all revenues that could have been generated by selling product A would be lost in the actual scenario. If the market offers an alternative, which is a similar material that can be used for production for product A, is available from another supplier, the claimant should take reasonable steps to avail itself of such alternatives. In that case, the actual position will be mitigated and the cash flows will be higher than the one that is assumed by the claimant, and therefore the damages is reduced. And very often, this is an area where a quantum expert would need to work with market experts in order to form a mitigated actual position. Using the same example above, is an alternative material available in the market for the production of product A? And what is the cost of using such an alternative? Or how long does it take to set up such an alternative arrangement and start producing again? Stephen mentioned that day of assessment is a key element in the legal principles when assessing quantum and damages. As he mentioned, there are two different approaches, day of breach versus day of award assessment. The day of breach assessment considers the loss as at the date when the wrongful act or omission occurs. And therefore, the assessment only considers information known or knowable at the day of breach. And all the losses are future losses, and projections would be required for both actual and counterfactual position. On the other hand, the day of award assessment considers the loss as at the day of hearing. The assessment considers all information that are available on such date. By then, some time should have passed since the wrongful act or omission occurred, and therefore, the impact of the wrongdoing has usually been reflected in the business performance to a certain extent. And so the actual position of the claimant between the wrongful act and the hearing is already known. However, a valuer still needs to assess what would have happened in the past under the counterfactual position. And again, projections are required for both actual and counterfactual position after the day of hearing. As you can see, the day of assessment therefore affects the information that can be used to determine quantum and can have significant implications for the overall loss calculation. Next, I would like to talk about discounting and interest, which is also highly relevant to the previous topic on day of assessment. As a valuer, we make a forecast of the future performance of the business for both actual and counterfactual positions. The forecast future cash flows would need to be converted into a present value through discounting. This is because $1 received today is worth more than $1 received in the future. Take a simple example. If you deposit $100 into a savings account with interest rate of 3% today, you will get back 103 after 1 year. Therefore, cash flows received in the future would need to be discounted back to their present value using an appropriate discount rate. And how should we determine an appropriate discount rate? It is related to the risk associated with the cash flows. That is, an uncertain amount of money is worth less than a certain amount of money in the future. In general, a higher discount means there is a greater level of risk associated with an investment and its future cash flows. Mustafa will be discussing this further later in this workshop. Consider the date of breach assessment. Remember, under this approach, all losses are future losses, and therefore, all the future losses should be discounted back to the date of breach when the wrongful act or omission occurred. As you can see, there is a time gap between the wrongful act, the hearing, and the day of payment of award. Interest, therefore, should accrue from day of breach to the day of award, which is called pre-award interest, and then from day of award to day of actual payment, which is called post-award interest, in order to compensate the claimant for being deprived of the use and disposition of capital that it was supposed to receive. Sometimes pre-award interest can represent an important portion of total damages. For example, in an ICSID case, Tenorus SA and Torta against Venezuela, which principal damages amounted to $87.3 million US, while pre-award interest totaled US $85.5 million. The most common interest rates used are contractual rates. If the parties have expressly agreed on a fixed rate of interest or a method for calculating interest, arbitrators will typically apply interest in accordance with the parties' agreements. And the second one is benchmark rates. Many awards provide for interest rates that are expressed by reference to floating commercial borrowing benchmarks, such as LIBOR or US Prime. Post-award interest is often applied at the same rate as pre-award interest. This reflects the view that interest is just compensating for the time value of money. An alternative view is that post-award interest should be higher than pre-award interest to discourage late payment. If we consider the day of award assessment, again, the future losses should be discounted back to the day of hearing. However, the loss that suffered before the assessment will be brought forward to their value at the day of hearing using the pre-award interest. And then this would accrue post-award interest together with the discounted future losses to the day of payment. All the previous slides describe the loss framework for expectation loss, which is to calculate the incremental gains a claimant may reasonably have expected to make. The claimant is put back into the position it would have been in if the investment has been made without the wrongful act or omission. In contrast, reliance loss is assessing the amount of money wasted pursuing the opportunity, which is often referred to as wasted cost, even though it can capture more than wasted cost. Sometimes investment expenditure, historical cost, sunk cost are also used to describe the expenditure in reliance. Reliance loss is to put the claimant back into the position it would have been in if no investment has been made. This is the money actually invested and lost, rather than value of opportunities forgone in reliance. For example, if the claimant invested $100 million in this venture. Under this approach, they are not claiming for the profits they could have made by investing in elsewhere. They are just seeking to get back the $100 million for what they have invested. One reason for taking this route could be that it is very difficult to prove whether such opportunities exist or whether the claimant would have invested in such opportunity. As you can see from the graph, reliance loss is the money actually invested and lost before the wrongful act or omission, whereas expectation loss is the expected future cash flows that did not materialize. Money invested is historical information, and the quantum expert does not need to make projections about the future. Therefore, there is generally less uncertainty in the calculations. A party can put forward alternative assessments of expectation loss and reliance loss. In general, reliance loss is often less than lost profits. Reliance loss may be kept to avoid claimant escaping a bad bargain. So for example, the claimant invested $100 million initially. However, the future cash flows that could be generated in the buffer position without the wrongful act is less than $100 million. The claimant has actually entered into a bad bargain by investing in this business with $100 million, and its loss is therefore kept at the present value of the lost profits. One very important point to make is that we need to avoid double counting when calculating losses. From an investor or claimant point of view, they may think that because of the wrongdoing, they have lost the amounts that they invest, any debt that they've taken on to fund the investment, and also profits from the investment. However, they cannot claim all of these losses. It is because either you would not have invested in the business, and therefore you claim for the money that you have invested and any debt taken on to fund the investment. Or you have invested in the business, and because of the wrongdoing, you now have lost the future cash flows from the investment. So reliance loss and expectation losses are alternative assessment rather than losses that can be added up together. I would like to pause here to take any questions. If not, please feel free to raise any questions afterwards. And now I will pass to Mustafa for the next section.
Thanks very much, Lydia. I see that there is a question from the audience. I think it might be one that's easier to pick up at the end, Alina, if that's okay. And we will come back to any questions there might be. So, Lydia, if I can just take control, I think I can. Here we are. Great, thank you very much. So I'll be speaking briefly about counterfactual positions, picking up on Lydia's description, and I'll spend more time talking about valuation principles. So as you'll appreciate from the issues Lydia's been describing, one of the key tasks for a damages expert is to construct a counterfactual position that is plausible and reasonable. That is where a lot of the focus of the debate ends up being. Usually that's where the greatest uncertainty is, as opposed to looking at the actual position. So in thinking about what makes a counterfactual position plausible, I'll start with looking at some things that make them implausible. And, three types of implausible scenarios that we come across quite often. The first is what I call for want of a nail. I don't know if you're familiar with the kind of children's nursery rhyme, for want of a nail, a horseshoe was lost. For want of a horseshoe, the horse was lost. And it continues until the battle is lost, the kingdom is lost. And kind of everything is lost. And it's all traced back to one very small cause. And sometimes you see parallels to this in a damages claim where some very small, relatively insignificant part of an enterprise, a business, a factory has failed, and some kind of cataclysmic failure in the business is attributed through a series of steps back to that one small event. And when you see that, you really have to question whether that is realistic. In particular, you have to consider whether there are ways of mitigating the effect of the small factor that were open to the claimant that they chose not to pursue, or whether there were other factors that contributed to that overall loss. Secondly is what I, sorry, trying to move the slides along here, called turning of the tide. So we also see businesses which have been unsuccessful in the past. Historically, they've been struggling, they've not been successful financially, they may be loss-making. But the story that's presented to the tribunal is, yes, things weren't great in the past, but the tide was just about to turn. The future was going to be wonderful. It was going to be so different to what you have seen in the past, if it wasn't for X or Y or Z that took place. And again, there you really do have to question how realistic is that given the context of the business, the market. Why was it that a business that has previously been unsuccessful would have been successful now? And what risks were there to that plan or vision? And thirdly, the sunlit uplands, or the perfect day sort of scenario, like the song, "It is such a perfect day." Everything is perfect. Everything would have gone to plan. Here's a glorious plan that we have, that we put together for this business. That's exactly what would have transpired. Business plans are all very well. They're very important to put together, to have a route map for the strategy you're looking to execute. And I worked as a business strategy consultant for many years before I started doing this sort of work, so I'm very familiar with them. But what I also know about business plans is they have to take into account the risks to what you're setting out to achieve being realized. And it's rare that a new venture or new business has a huge opportunity that they're presented with, and that does not come with risks, either competitive risks or other risks of their proposition being successful. So what does make for a plausible counterfactual scenario? How do we avoid those three classic errors? Well, firstly, you have to understand the characteristics of the business. So I think it's important not to see this exercise as an accounting exercise. Sometimes it can be, but more often than not, this is an exercise that requires an understanding of the business, an understanding of what drives value in that business, so that you can put into context whatever issues are complained of in terms of the alleged kind of act or omission. And you can understand commercially how you'd expect that to impact the business, what alternatives there might have been, etc. Secondly, it's also important, this seems like it's stating the obvious, but it's amazing how often people don't do this thoroughly. It's important to look at contemporaneous evidence. So not just things prepared for the purposes of the dispute, the arbitration, but what documents are there that were prepared at the time, particularly by the parties who are now parties to the arbitration. For what purpose were they prepared? And are the conclusions that we're now reaching consistent with what those would suggest? Thirdly, past financial performance. I talked about that on the last slide. Fourth, market context. So what is happening in the wider market? That, we can't just focus on the financial statements of one company. We have to look at the performance of this company in the context of what's happening in the market, particularly pertinent at a time like this. And lastly, what other available cross-checks are there? So often by looking at the behavior of different parties in the dispute, the decisions that they chose to take, the actions they chose to take commercially, that will tell you something about the value of different aspects of the business, opportunities, losses, and you have to consider any such cross-checks that are available. So lastly, just one slide to talk about an example of how this might work in practice. This is a case that we came across where there was a purported loss bargain on an aborted deal. So a deal was struck, the deal fell through, and the buyer put in a claim around this aborted deal to say, well, the actual bargain has fallen through based on the kind of counterfactual position that the bargain that was struck. Had that gone through, we would have made this enormous gain. So essentially what they were saying was, the price for the target that was agreed was the dark blue bar there. The value of that target company to us, the buyer, was actually much higher than that, they were saying. And that delta is the benefit they would have got of that bargain, which they said they had lost. So how realistic was this claim that they were putting forward? So the claimant's expert relied on forecasts that were prepared by the claimant for the purposes of the dispute. So by the buyer. Now the buyer would have looked at this business very carefully when it was actually putting money on the line, negotiating the deal. But the expert relied entirely on forecasts that were prepared for the purposes of the dispute, rather than looking back at what was being relied on for the purposes of the deal. The expert valued the business at 500 million euros, which was a huge premium, $200 million over the agreed purchase price. So, does that make sense or not? Well, what that implied or suggested was that this was going to be some kind of transformative deal with substantial synergies or benefits arising from the deal for the buyer, and unique benefits in some way. So what cross-checks were there that we could look at to see whether this made sense? Firstly, it was a competitive transaction process. So this wasn't just a bilateral negotiation. It was a process run through an investment bank that reached out to various parties that thought might be interested. There were multiple bidders, and there was a sort of auction, if you like, which resulted in this price. So you would expect that the price in that auction would have been bid up to the highest price that anybody was willing to pay for this asset. So the second question was, and this is an important one, were there any synergies that were unique to that buyer? Was there any value in that asset that was unique to that specific purchaser, but that others would not have realized? So was there some value in combining the buyer's business and the target business that would have generated additional value beyond that available to anybody else? Now, in theory, this could be a reason, a logical reason why the value of the target to the buyer could have been much greater than to others. But there was no evidence in the contemporaneous documents that there was such a huge amount of synergy, or in fact any synergy identified in the deal documents, in the due diligence, in the investment committee papers that signed off on the transaction, etc. Further, the buyer was a listed company, and the buyer's share price, which is an estimate of what buyers and sellers in its shares, its investors, considered to be the value of that business, was unaffected when they announced the deal to the market. So if the market had really believed that they were creating $200 million or euros of additional value just by signing this deal, would have expected that to be reflected in the share price, but there was no such thing. Analysts, which mean equity research analysts that covered this listed company as a buyer, were pretty neutral on the transaction. They didn't take the view that the company was getting huge value or bargain on this deal. And finally, the transaction that eventually replaced this, the water transaction 18 months later, valued the business at 250 million euros. So all of these things were being ignored essentially by the claimant's expert, were pretty instrumental in challenging that expert's view. That is all I'm going to say on counterfactual scenarios. I'll now spend about 20 minutes or so talking about valuation methodologies. So firstly, this is a bit of a transition from the topic we've been covering so far of damages to valuation. So it's important to explain the link between these two. So valuations can be needed for many reasons. In the context of a damages issue in a dispute, there are some types of situations where a valuation analysis is needed to answer the question around damages. So one example might be where an entire business or asset has been lost. For example, if a business has been expropriated, in that case, your counterfactual position, the but-for position, you have to value what that business would have been worth had you still owned it, had it still been in your hands. Secondly, there might be something that has happened that has had such a pervasive impact on the business, like a key supplier contract defaults or something, that the entire business is essentially made valueless, or there could be a series of small effects which in total have a very significant impact on the business. And this would be a reason why you might want to, as a sort of a shortcut to quantifying all the elements of loss, you might want to value the business as a whole. or alternatively as a cross-check if you're valuing lots of small components to make sure that the total that gives you is reasonable in comparison with the value of the business as a whole. But it's another reason why you might want to estimate the value of the business. And thirdly, claims related to transactions, mergers, acquisitions, purchases and sales of companies or shareholdings in companies, such as breach of warranty or misrepresentation claims. These frequently require a valuation of a business. So that's sort of the link from the damages analysis into valuation. So firstly, what do we mean by the term value? There's many different definitions of this. There's one here that I've selected to put on the slide, and I think I will read it out. The opinion resulting from a valuation process, it is an estimate of either the most probable monetary consideration for an interest in an asset, or the economic benefits of holding an interest in an asset on a stated basis of value. Quite dense, probably quite hard to follow. I think the key points are it's an estimate. It's an estimate for the amount of money that you might either receive in exchange for an asset, or an estimate of the amount of money that represents the economic benefits, the value you will get from holding that asset into the future. And it says on a stated basis of value. So what do we mean by basis of value? Well, if I give you a slightly facetious example, if instead of valuing a business, the task was to establish the weight of a watermelon, there might be some parameters that you need to specify to make sure everybody was answering the same question and understood the question to be the same. Are we valuing the watermelon including the packaging or excluding the packaging? Are we valuing it on the day it arrives in the supermarket, or when it was still growing on the vine, or 2 weeks after it arrived when it's dehydrated? Obviously the value could change, the weight could change over time. And thirdly, what's the context of the environment at the time? Are we valuing it on Earth, on the moon, in different gravity conditions, etc.? So a bit of a silly example, but it works quite well when you're thinking about valuation. There are things that you have to specify, parameters that you have to specify to make sure people understand the basis on which the question is being answered. And the second paragraph there sheds a bit of light on that. While there are many different bases of value, most have certain common elements: an assumed transaction, an assumed date of the transaction, and assumed parties to the transaction. So just before I move on to the next page, just to kind of sum up, there's many different bases of value. Market value is probably the one that you will come across most often. So I'll talk a bit about that on the next slide, but there are certainly others. And what is the right basis in a particular situation is usually a legal question. And there are times when this can have a large impact on value. Often the difference between is it value to a specific party or market value in general. So I mentioned market value. I said I'd talk a bit further about this. So this is a definition from the International Valuation Standards of market value: the estimated amount for which an asset or liability would exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing, where the parties had acted knowledgeably, prudently, without compulsion. So what's within that? Firstly, it's an opinion, it's an estimate, so I mentioned earlier. Secondly, it's context dependent, timing, who the parties are, etc., is specified. Thirdly, it's looked at through the lens of a transaction, a hypothetical transaction in this case, but a transaction with certain characteristics, an orderly sale. And lastly, it's expressed in the form of the sum of money that is exchangeable for that asset. So you can express the value of an asset in other terms, but this is expressed specifically in terms of money. So moving on from bases of value to the factors that drive the value of an asset. We can think about value as being driven by three key factors. The first is the expectations of the future performance of that business. So I say value here, I'm talking about value of a business, and I'm thinking particularly of trading businesses that operate and generate profits. There are companies, of course, whose purpose is just to hold assets. They're slightly different. But certainly if you're thinking about the value of an operating business, the first question is, not just what profits is that business producing today, but what are your expectations of growth in that business? Secondly, what is the risk or level of uncertainty associated with those future performance, those future expectations? And thirdly, and I put this in white because this is more of an extrinsic kind of market factor, what alternative investment opportunities are available at that time in that market? Because how much you pay for this business will be a function of the alternatives that are available and how attractive this business is relative to those other opportunities. So it's useful to think about these three factors. Whatever valuation method we're taking, and I'll talk now about valuation methods, this is sort of an overarching conceptual framework around what is driving value. So in terms of valuation methodologies, I put 4 boxes here on the slide. These are often described as 3 different approaches. I think box 1 and 2 are usually put into the same bucket, but I thought it was helpful to distinguish between them, mainly to draw attention to box number 1, which is sometimes overlooked. So box 1 and box 2 are really market-driven approaches. So there's a market that has information on a price. How do we use that to determine the value of our asset? Either looking at past transactions in this subject asset or looking at transactions in comparable assets. That's 1 and 2. Thirdly is DCF, discounted cash flow. I'm sure that's a term you'll have heard many times. People don't always describe what it means, but it's certainly applied quite a lot. And that's an income-based approach. So it's based on the idea that the value you're going to put on something is a function of the income you expect it to generate. And fourth, lastly, and I've put this in a dotted line box because it's less relevant in the context of damages issues, is an asset-based method. So you can look at value through the lens of what assets am I getting and what are those assets worth. So just to talk through each of those in a bit more detail, starting with the first one, transactions in the subject business. So this is a really obvious one, but I'd say surprisingly sometimes overlooked or not given enough weight in my opinion. Where this is available, so where the specific company you're trying to value or the shareholding you're trying to value has actually been transacted in at a time that's not too distant from the valuation date, that's a very important reference point for the value of that asset. Now, we do need to understand the circumstances of the transaction that actually took place from which we're going to take this information. We have to look at its timing. How sort of fresh is it? How relevant is it as at the valuation date? Is it a long time in the past or relatively not so far away? Has the market generally been stable or very volatile? In current market conditions, 6 or 9 months may be a lifetime. In other market conditions, 3 years ago, may not be that significant. And the nature of the transaction, was it an orderly sale? Was it a fire sale? Was it on arm's length terms, or was it between connected parties where we can't be sure as to whether it was on arm's length terms? So an example there, transaction in a property. Are we looking at the transaction a week ago, 10 years ago? Is it a normal sale? Is it a foreclosure? Essentially the same points that I just described. And a final point there that in addition to transactions, while closed completed transactions are clearly the best guide, if we do have indications of interest, offers for the business, offers to buy, offers to sell, these are also worth examination. In some cases, they may be more useful than others. If it's an offer that's a fully funded offer supported by debt commitments, financing commitments, that may be more indicative than one that's purely speculative, non-binding, etc. So there's offers and then there's offers, but it's a reminder not to ignore that as a possible source of information. So the second box in my original slide, the top right box, was transactions in comparable businesses. So how useful is this? Well, it depends on probably 2 factors. homogeneity and observable value. So the more homogeneous the asset is, the asset and the other assets that you're going to look at are, the easier it is to apply this method. And the more observable the value is of those comparable assets, the easier it is. So on the left, we have gold ingots, if they're standardized, kind of size, quality, dimensions, carats. One is much like another. Value is certainly observable, is quoted on listed exchanges, printed in newspapers every day. You can easily understand what that value is. Moving to the center, we have a property, and that's a picture of what looks like a house in the US or Europe or somewhere. In Hong Kong, with apartments, it's somewhat easier, I think. Things are more homogeneous rather than less homogeneous, but clearly it's not as standardized as gold ingots, and it's not as liquid a market, so you're not going to get published prices on a daily basis. But anybody thinking about buying an apartment or selling one in Hong Kong would look at other transactions in the same building, estate, etc. See how many they were, how far they were in the past. But we'd all look to that sort of information. And observable value, those values are normally publicly available. Third example on the right, the W is the World Wrestling Federation, a business, very unique, very bespoke, very hard to find similar businesses, and very hard to observe values of those similar businesses. So a bit more detail in terms of the specifics of how we do this. So when we have comparables, the idea is to find a business that is similar to your subject business, and this comparable business that you found is either listed on the stock exchange so that there are share prices available, so the market is putting a value on that business, and that can be your starting point from which you try and infer the value of your subject business, or that the comparable business that you found has been bought or sold in recent times, so that there is some value established by the market through kind of one large transaction. That can be your starting point. If there's no observable value, there's no way to apply this approach. But what does constitute a comparable company? And this is a question which invariably leads to much debate when this approach is applied, and which is why a transaction in the subject asset itself, the first of the 4 boxes that I talked about, I think is a very powerful starting point, if there is such a reference point, because there you only have to consider the circumstances of the transaction, how much they have changed, and how much time has elapsed in market conditions. You generally don't need to consider whether the asset itself has changed, except in some exceptional cases. So what does constitute a comparable asset where you are looking to other businesses? Well, it goes back to the slide I started with the 3 key drivers of value. If you remember, the 2 blue boxes were growth expectations and risks. And those are the key things that we're looking at. In this situation, the third element we had was alternative investment opportunities, which is the market context. So the market context at any one point in time is the same for all these companies. So the key question is, from a growth expectations perspective, from a risk perspective, what companies can we identify that are similar to ours? So are they in a similar industry? Are they at a similar stage of maturity in their own development, startup versus established? How are they financed? Are they heavily debt dependent? How big are they? Larger companies tend to be more institutionalized, have more market power. What country are they in? Are they operating in? And how diversified are they, both in terms of outputs and products, but also inputs, is also relevant to the risk. So these are sorts of factors that you should be thinking about. We'll speed up slightly because I think I'm running slightly behind on timing. So performing a multiples valuation, how do we sort of run the numbers in practice? I'll just lay this out on the slide. So the idea here is you've got your target company, company A. You've identified your comparable company, company B. Company B is valued by the market based on a listed share price at $1 billion. How do you scale that to say based on that company being worth $1 billion, how much is company A worth? And usually you start by identifying some scaling factor or some way that you're going to measure, if you like, the size of that comparable business. Very commonly, we use profit, and very commonly, a particular measure of profit called EBITDA, earnings before interest, tax, depreciation, amortization. This is profit essentially before many of the non-cash items that go into accounting, and before tax and interest. So you can think of it as a kind of underlying cash profits of the business. So we identify that what sizing measure we're going to use. We say for company A, which is our subject company, it's making profits, EBITDA of $10 million. For company B, we looked at it on the market, it's making EBITDA of $100 million and is valued by the market at $700 million, EV's enterprise value. So its enterprise value to EBITDA ratio is 700 over 100, which is 7. And if we apply that same multiple to our target company, subject company A, with this profit of 10 million, 10 times 7 gives you a value of $70 million. So the calculation itself is relatively simple. It's all about the selection of the comparables. There are a couple of points. I won't go into too much detail on these. Even within that, there can be some complexities. Are we using the right measure? Are we scaling when we're scaling it by profit? Should we be scaling it by something else? Should we be looking at the profits for this year, for last year, forecast for next year? Are we using normalized profits, i.e. the profits, is either a target business or a comparable affected by any one-off events which are unique, which will not recur in the future? And do we need to strip out the impact of that on the valuation? And so on. So moving on from multiples and the market method to the DCF valuations, the other kind of main box that I referred to. Discounted cash flow, as I mentioned, is an income-based approach to valuation. It's also a technique that's often used to quantify future lost profits in a damages claim. So as well as being used purely to value businesses, it's also used to quantify future lost profits. And I think Lydia gave a bit of an example on that. So the idea here is that value, what you pay for a business, is a function of the future profits you expect it to generate for you. So you start with a projection of what you think those future cash flows, future profits are going to be. So in this case, you're expecting to get $100 at the end of year 1, 110 at the end of year 2, et cetera, up to 140 at the end of year 5. And the question is, that's your expectation. They are in the future, and there is obviously some uncertainty associated with those. So how much would you pay today to essentially buy the rights to these cash flows together with the associated uncertainties in the future? And we apply something called a discount rate. Sorry, the slides sometimes just slow down as we're moving along. So we apply a discount rate to convert the value of that future cash flow into a present value. So in this example, we're applying a rate of 10%. So if you just look at that first box, year 1, $100, and below it times 0.91, what that's saying is that if you take your $100, which you receive in a year's time, and you divide it by 110%, essentially, 1 plus the discount rate, you get 0.91, which is saying that if you had $91 today, and you were to earn a return on it of 10%, in a year's time, that would be worth $100. So if you're going to get $100 in the future, they're kind of worth $91 to you today. You repeat that exercise and add up all the cash flows, and essentially that's how you come to a view on a discounted cash flow basis of value. So what are the key inputs that go into this? There's 2 key inputs. One is the projections, the second is the discount rate. So starting with the discount rate, this is dependent on 2 factors. Firstly, the time value of money. $1 today is worth more than $1 tomorrow because you can invest that dollar in a fairly low risk asset like a bank account or buying a government bond, and you can earn interest on that money in the interim. And secondly, risk. So obviously a certain dollar, if you like, is worth more than an uncertain dollar. Now, this discount rate is not something that can be observed directly. It is something that needs to be estimated. And because it needs to be estimated, and many technical issues kind of come up in estimating this, it's often a subject of disagreement between experts. It's the sort of thing that can turn into a big kind of expert fight. Sometimes it has a very material impact on the answer. Sometimes it doesn't. So it's important to have an eye on the bigger picture and not be too distracted by issues that experts are wanting to make bigger if they're not very material. And secondly, on the right-hand side, we have forecasts. So these are the cash flow projections of forecasts to which the discount rate is applied. Now, the kind of conceptual theoretical ideal is something like what's shown here, that those forecasts should represent the expected values of future cash flows. That's expected in a mathematical or probability sense, i.e. weighted by probability. So looking at all the different possible future scenarios, assigning a probability to each of those, and then working out a probability weighted average. Do we see that in practice? Is this a sort of projectional chart you'd see in many expert reports? I think the answer is more often than not, no. What you tend to see is something more like that. As long as that single scenario you're looking at is reasonably representative of the probability weighted average, that's okay. It's not necessarily a problem. But we do have to watch out for situations where that is not the case. So, if we're taking a forecast that is inherently optimistic or pessimistic, as opposed to a central expectation. What should we keep in mind when looking at the forecasts that are available and choosing what to adopt? Sorry, that's slightly moved ahead by itself there. So some of the factors, what's the provenance of those forecasts? Where do they come from? Who prepared them? What purpose were they used for? If they were submitted to a bank to obtain financing, does that mean they're likely to be more reliable than those used just for internal purposes? And what bias, if any, directionally would we expect if it's a forecast used to set up a stretch budget for management to meet? You'd think it would be upwardly forecast. Some other uses might be downwardly forecast, but understanding the purpose and what that's likely to mean. Looking at the accuracy of previous forecasts prepared by the same business or lender or function. Are they generally good at preparing forecasts or not? And are they consistent with other evidence that's available? Competitive forecasts, market analysts, etc. And then just to wrap up, so we've talked about these four, or at least three of the four methods. Which is the best? I'm going to resist the temptation to try and do a straw poll of the audience, because the answer is that's the wrong question. And the real question is, the real answer is, we should be seeking to apply as many of them as we can in the circumstances with the information available and given the context, and then to triangulate on the overall answer. And that is not just what we would do, but as you can see here from the survey, what most experts try and do in practice. So they're trying mostly to use 2 or 3 different methods and then triangulate on the overall answer. Which method is appropriate in which context? As I said, depends on the context, the industry, stage of development, what information is available. All these things will determine the applicability and usefulness of these different methods. So there is no absolute ranking of what is good as a method and what is bad. And finally, general propensity of use, disputes versus the real world. I don't think I've got the chart in here that we sometimes use, but essentially what we find is that in the real world, when we look at sort of fairness opinions or listed company transactions, the focus is mostly on income-based things like discounted cash flow and market-based valuations like transactions in the subject asset and comparable assets. When we look at arbitration awards, ones that are publicly available, we see a weighting towards cost-based awards, wasted cost type approaches, often justified on the basis that there's too much uncertainty to take an alternative approach. Not perfect in our view from a finance perspective, not optimal perhaps, but that is the reality of how tribunals often behave. I'll stop there. Lydia, I think I'm going to hand over to you now to talk through climate change issues, if that makes sense, and how that impacts on valuation. I see we do have a number of questions. I'll start having a quick look through those, and hopefully we'll have time to come back to those at the end.
Sure. Thank you, Mustafa. So after understanding the key principles of valuation methodologies, we would like to discuss how valuation concepts can be applied to climate change related issues, which is a hot topic nowadays. So climate change and ongoing transition to a low carbon economy are expected to have significant financial impact on many businesses. There have been a number of developments in recent years relating to the disclosure of climate-related information in financial reporting and the use of such information in company valuations. The Financial Stability Board, FSB, is an international body that makes recommendations about the global financial system. It created the Task Force on Climate-Related Financial Disclosures, TFCD, in 2015. The TFCD was set up to develop voluntary, consistent climate-related financial disclosures that will be useful to investors, lenders, and insurance underwriters in understanding material risks. The TFCD published a set of disclosure recommendations in 2017 that can be applied by organizations across sectors and jurisdictions. The TFCD identifies certain categories of climate-related risks. In broad terms, risks are categorized into transition risk that arise as the world transitions to a lower carbon economy, and physical risk, chronic changes that are expected to impact assets and operations, etc. And it recommends that this disclosure are made in the mainstream and public annual financial filings and are centered around 4 thematic areas: governance, strategy, risk management, and metrics and targets. In broad terms, businesses would disclose how their board and management are informed about climate-related risks and how this influences their strategic decision-making, and how business are managing climate risk, and what, if any, climate-related metrics do this business track and target. There has been a gradual push towards mandatory climate-related disclosures by governments. In 2020, the UK Treasury published a roadmap setting out a 5-year timeline for mandatory disclosures based on the recommendations made in the TFCD. In March 2022, the US Securities and Exchanges Commission proposed climate change disclosure requirements for US listed companies. The TFCD recommendations focus on disclosure, less so on how that disclosed information is used in assessing potential financial impacts. It lists one of the key areas for further work is further research and analysis to better understand and measure how climate-related issues translate into potential financial impacts for organizations in financial and non-financial sectors. In February 2021, Accounting for Sustainability, A4S, an organization advocating sustainable business practices, published the A4S Essential Guide to Valuations and Climate Change, which sets out a conceptual framework for factoring in climate change in business valuations. This guide was developed by a group of organizations comprising pension funds, PE funds, and other sector standard settings bodies. The A4S Valuation Guide builds on the TFCD recommendations. Based on standard valuation theory, the guide provides a conceptual framework on how to reflect identified climate risk and opportunities in valuation assessments. And this is a 5-step process, which is summarized in the graphic on the right. I'll briefly cover step 1 to 3, which are general considerations that we need in conducting valuations, but more explicitly tied to climate change related factors. And then I will explain in more details for step 4 and 5 on how to make appropriate adjustment to the valuation models. The first step of the process, identify, involves understanding the subject business or asset, in particular its key value drivers. In addition, the operating environment should be considered. This includes both the physical location the business is in and the institutional environment, such as competitive and regulatory landscape. These can have specific climate-related considerations. And step 2, assess, which means consideration of climate-related risk and opportunities. As we just mentioned, there are two main categories of risk, transition risk and physical risk. Transition risk arises due to a shift in attitudes towards climate change. Physical risk relates to environmental changes that can adversely impact the operations of the business or asset. Types of transition risk include policy. Government could introduce policies to reduce the impact of climate change, which can change the energy and transport costs. Second, which is legal. The business could face legal action in relation to climate change, which can increase litigation expense. Third, on technology. Business activities could be disrupted by low carbon technology. The operation and production processes and costs may be changed. Fourth, on market. Changes in consumer and competitive behavior that could affect demand and supply. And lastly, on reputation. Reputational risk relating to climate change, for example, with consumers, employees, and investors. And on physical risks that include two types of risk. The first one is chronic, which is slow onset shifts in environmental factors such as temperature changes, sea level rise. This can affect the availability and cost of production inputs, productive land, supply, and distribution chains, etc. And the second type is acute. Risk arising from extreme weather events such as flooding, fire. This has an impact on physical assets and operations. Business may also find opportunities in responding to climate change. The TFCD has identified a number of categories of potential opportunities. For example, new products and services can assist adaptation to climate change, such as development of low emission goods and services. And step 3 is to filter by conducting a likelihood and materiality assessment. Two factors should be considered: likelihood of occurrence and materiality, or the financial impact the event could have. In considering financial impacts, a number of factors could be considered. First, cost of reacting to the climate change risk after it has occurred. Second, cost of mitigating the climate change risk before it occurs. Third, with respect to opportunities, revenues, and costs required to realize those revenues. And lastly, the timing of the expected event or impact. Under the framework, a sliding scale from low to very high is assigned for each likelihood and materiality assessments. These are then combined for an overall rating. After going through step 1 to 3, we will consider how to make relevant adjustment to the valuation models. After giving a rating to each of the risk and opportunity factors, their impact on valuation should be considered. Under the DCF approach, adjustment can be made either to first, cash flows, or second, discount rates. As a general point, if the cash flow impact is more quantifiable, reliable, and certain, then it is much preferable to adjust cash flows. Climate change can impact all elements of cash flows, including revenues, costs, and capital expenditures. We should watch out for regulation that is affirmed in law and whether there is any uncertainty around timing. The guidance states that the adjusted discount rate should be used when you cannot easily or reliably quantify the impact of climate change on the business. But think it will probably have a significant impact on value, and the discount rate impact can be reasonably estimated. In terms of finance theory, the preference is always to adjust the cash flows, but this approach is also applied by market practitioners. If the discount rate is adjusted, it is necessary to consider whether the risk or opportunity in question affects the entire industry. If so, it could already be priced into the discount rate by the market. And under the market approach, it is necessary to consider whether an adjustment to multiple is required. The framework provides a three-step process for determining the need for adjustments. First is to assess the comparability of the risk and opportunities identified. To assess the comparability, we can consider geographical impacts. Certain locations are naturally more exposed to both physical and regulatory risk. Consider the difference this could create if the subject entity operates in a different location. Sector-specific factors. Certain sectors are inherently more exposed to climate change risk. We should consider if the subject or peer entity straddles two sectors. Second step is to assess industry-specific metrics, for example, average carbon emission by revenue or customers served. And last step is to adjust the multiple. Based on the relative assessment of the risks and opportunities of the comparable companies and the comparison of industry metrics, assess whether any adjustment to the multiples are required. We should be careful that there are many factors that go into the selection of multiple besides the climate risk and opportunity factors that we just discussed. And the final step of the framework is triangulation, where we consider the climate change adjusted valuation based on either DCF or comparable methods against observed market valuations. There are a few relevant considerations when assessing market valuations. The market may not be fully pricing in the risk related to climate change. This could result in dislocations between current market valuations and valuations after adjustments have been made for climate change factors. These market dislocations could change in the future. When markets fully account for climate impacts in valuations, they may impose significant discounts on climate risky businesses. It is necessary to consider factors such as anticipated holding period, exit strategy, and assumptions regarding terminal value or perpetual growth. Since climate change impacts will become more significant over the long term, for example, businesses that are heavily exposed to climate change risk could be difficult to exit in the longer term. And now I will pass to Stephen for some remarks on the climate change related risks and opportunities in the context of dispute.
Thanks, Lydia. So climate change related litigation is very much at its infancy at the moment. Just to give you an overview, most legal action at the moment is concerned with activist groups bringing legal actions against governments to challenge various government decisions or policies by way of judicial review. One fairly active group is Client Earth, whose stated mission aim is to use the power of the law to protect all life on Earth. And so Client Earth has, for example, challenged a decision of the UK government to build a new gas-powered electricity generation station. We are, however, starting to see some legal disputes take place in the private sphere, where the defendant is not a public body, but a private company. Again, with Client Earth, they have bought some shares in Shell and then used their rights as shareholders to bring a legal claim against the board of directors, alleging a breach of duty on the basis that the direction of the company taken by the directors is not in the long-term interests of the company or its shareholders because it fails adequately to take into account climate change considerations. What is very rare at the moment, though, are actions being brought against private companies for compensatory damages as a result of climate change. I'm aware of one unsuccessful attempt in the United States by an Alaskan village against ExxonMobil and other oil majors for damages as a result of climate change. But these actions are very rare at the moment. The critical difficulty, or at least one of the difficulties faced by such claimants, is to show a causal link between, for example, the carbon emitter and a specific loss they have suffered. There are questions at the moment as to whether the science allows us to prove such causal links. However, I think the legal profession does expect there to be an increase in climate change related legal action in the coming years. In particular, one issue which may well arise in the context of business disputes is how government legislation will impact on the profitability or otherwise of a particular business venture. For example, if you are invested in fossil fuels, the profitability of such company may well be affected by government action, reducing the amount of carbon emissions. And similarly, if you are investing in renewable energy companies, that company may well become more profitable as fossil fuels are more and more restricted. So this is an area where very much it's a case of watch this space, as there will no doubt be future developments. So with that in mind, I'm going to hand over back to Lydia and Mustafa. I think we will probably have a Q&A session.
Thank you, Stephen. Yeah, I see we do have a number of questions that have come through. Let's try and see if we can answer at least a few of them before 6:30. So one of the questions is around expectation loss versus reliance loss, and in particular, when quantifying damages, what kind of evidence would need to be used to justify the counterfactual position? So look, I think the answer to that is very much dependent on what the claim is about. So it's hard to give you a generic answer. Obviously, the key question is, if you as claimants are putting forward a claim, you are going to be asked to defend that counterfactual position. You're saying the actual position was that we made profits of 100, say, in the counterfactual, we would have enjoyed better performance. And this is our estimate of that. So what are the key variables that are going to drive your calculation? And you need to think about supporting each one of those. This projection that you have of how much better your business would have been and its performance would have been, how do we support that? So the sorts of things that you might think about are business plans that show what you expected the performance to be, contemporaneous forecasts of your cash flows that were prepared at the time or before the breach that you're complaining of. You can look at where some of those discussions around the impact of the kind of breach or omission might have been discussed. So board meeting minutes, for example. If these are listed companies that are involved, listed company announcements to the market when there's material new information. But it's really about what can you use to support the key assumptions that the tribunal will need to accept in order to accept your damages calculation. How can one be persuaded that that is what would actually have happened? What would you find persuasive? And mitigation, as Lydia mentioned, is the other thing. You could look at things like correspondence between the company and third parties. What did the company try to do to react when this problem occurred? Did they contact other suppliers, other customers? How many? Internal meeting minutes might document what other options they considered, what actions they considered taking, and maybe decide not to take it, and for what reason. So it's very context dependent. Those are the sorts of documents that sometimes we might see. Stephen, is there anything on the legal side that you'd like to comment on in terms of the questions?
So you raised the interesting question about mitigation. There is a couple of things I could say on that. Firstly is that when it comes to the question of mitigation, the burden on the party who has been legally wronged is actually quite a low one. And so it's quite difficult to show that there has been a failure to mitigate. But secondly, and related to that, in order to it's generally useful if you have been accused of breaching a contract to put some pressure on your counterparty to say, you should be mitigating by doing X or Y or Z at the time. And that would be very useful in due course in showing that your counterparty has failed to mitigate if your counterparty has failed to do X, Y, and Z. The worst possible thing you could possibly do when it comes to mitigation is simply do nothing, allow the losses to accumulate, and then with the benefit of hindsight, say, you should have done X, Y, and Z without there being any kind of contemporaneous evidence.
That's very helpful, Stephen. And also, in my understanding, correct me if I'm wrong, is that the kind of injured party has a duty to take reasonable steps to mitigate its loss, and if it incurs costs in doing so, even if the outcome ultimately, whether it's successful or not successful, costs that reasonably incurred to try to mitigate can also feed into the amount that they are claiming.
Yes, that's absolutely right. So even if you reasonably attempt to mitigate, but you actually make things worse, the costs or losses suffered as a result of making things worse, they are recoverable from the counterparty.
Yeah. No, that's helpful. But there's a question about interest rates and how do you work out, if there is no contractual rate fixed by the parties, what can you do? This is very much a how long is a piece of string type question or answer. You see a massive range of different approaches taken. One approach that's often taken is the claimant is essentially saying, I've been kept out of the use of these funds for a period of time. So one lens to look at it through can be, for that particular claimant, what is their cost of borrowing? If they have debt, most companies have a certain amount of debt finance. What is the interest rate that they're bearing on that? If they had the funds earlier, what they would actually have done with them is a factual question, probably complex. But one thing they could have done is to repay some of their borrowing, and they would have saved the rate of interest that they were paying. So approaches like that can be a way to get to an answer. Another approach could be, if you had that money and you had deposited it, you would have earned X%. But most claimants would consider that, that would usually be a low percentage. And if you could have saved a higher percentage by repaying some debt, that would be a more realistic way to do it. So those sorts of approaches tend to be used in those cases. I don't know if there's any additional questions. I think those are the main ones, Stephen, apart from somebody asking if we're going to circulate the slides, which I believe we are. So I hope that they're helpful to people, and they do contain contact information for all three of the speakers. So obviously, if there's follow-up questions that people have later, we'd be happy to hear from you. I think that might be it, Stephen, Lydia, in terms of questions. So we'll give people another 10 seconds, 20 seconds, but unless there's any more, I think we can wrap up. Thank you very much, Stephen, for joining all the way from London, and a very useful contribution to the presentation. Thank you, Lydia.
Thank you both, and thank you everyone who's attended and been patiently listening to us.
Absolutely, it's quite a long seminar, so we definitely appreciate your patience. Thank you all, and look forward to seeing you all again. Thank you. Bye-bye.
Thank you.
Thank you.
Good evening. Bye.